China's 1 trillion surplus, turning pain into gain. China's continued export expansions in 2025 underscores a fundamental shift in the global trading systems, one that tariffs alone cannot reverse. Despite stiff U.S. tariffs under President Donald Trump's protectionist agenda, China's goods trade surplus for the first 11 months of the year reached an unprecedented 1.076 trillion US dollar, crossing the trillion dollar threshold for the first time. The November 2025 figures tell that total exports rose by 5.9% year on year. China's ability to withstand such a dramatic contractions in its traditional anchor market while still maintaining overall exports growth reflects not only the depth of its manufacturing base but also a broader reordering of global demand toward Europe, Southeast Asia, and other parts of global South. The key is this diversification is neither sudden nor accidental. Over the past decade, China has woven itself into supply chains across Europe and Asia, becoming indispensable to the productions of machineries, electronics, and renewable energy equipment. As exports to the United States plunged by nearly 29% in November, shipments to other majors surged. For example, exports to the European Union grew by 14.8%, and those to Southeast Asian countries or group as ASEAN countries increased by 8.2% in November alone. These trends reflect deeper structural dependencies. Europe now relies heavily on Chinese components to support its energy transitions, while Southeast Asia depends on Chinese machineries and intermediate goods to increase rapid industrial upgrading. U.S. tariffs may divert some bilateral flows between China and the U.S., but they leave intact China's centrality in the global production networks that underpins these transformations. At the same time, China has also simultaneously accelerated efforts to diversify its import sources, especially for agricultural and food commodities. This shift reflects a deliberate strategy to reduce vulnerability to supply disruptions and political tensions. In 2025, China increased imports of soybeans, crude oil, and iron ore, with soybean purchasing rising 13.4% year on year to 8.11 million metric tons, driven primarily by strong inflows from Brazil and other Latin American suppliers. China also expanded imports of beef and seafoods from Brazil, Argentina, and Peru to meet fast-growing domestic consumptions. These reorientations toward Latin America strengthens China's food and resource security and provide Beijing with strategic insulations against future tariff escalations or supply chain shocks in food, commodities, and agricultural products. Within this evolving landscape, ASEAN has become a critical shock absorber for China exports engine. The region's expanding manufacturing capacity, large consumer base, and increasingly dense trade and investment ties with China have created a smooth, high-volume flow of intermediate and final products. Vietnam, Thailand, Malaysia, and Indonesia are now central to China Plus One production strategies, in which Chinese firms shift certain stages of manufacturing abroad while keeping control of high-value inputs, technology, and design. This has driven a surge in intra-regional trade, particularly in electronics, automotive components, and renewable energy equipment. Far from displacing China, ASEAN's rise has reinforced China's export ecosystems, allowing Chinese firms to scale productions, reduce cost pressures, and diversify risk in the face of geopolitical uncertainty. China's export resilience is increasingly rooted in advanced industries where it has established competitive advantages. Electric vehicles, solar panels, semiconductors, industrial robotics, batteries, and digital technologies are now form the backbone of China's export machine. These sectors benefit from unmatched economies of scale, dense supplier ecosystems, and years of state back of industrial upgrading. The result is a level of cost efficiency, technology sophistications, and production speed that even major Western economies slower to implement industrial policy and worry of deepening dependence struggle to match. This helps explain why analysts now expect China's shares of global exports to rise to 16.5% by 2030, reflecting both momentum and China's ascent up to the global value chains. The China trillion-dollar surplus is not simply a sign of excess productions. It is the outcome of a structural transformations in global manufacturing, shaped by green technologies, advanced industrial systems, and digital and AI infrastructure. China's rise shows the global integrations anchored in competitiveness, scale, and openness remains a powerful engine of growth. For many emerging economies, China's exports expansions brings both opportunities and challenges. Low-cost electric vehicles, solar technologies, and digital manufacturing equipment offer a pathway to accelerate industrial upgrading, meet climate change commitments, and boost productivity. Now the question is whether other economies see China as a partner or as a rival. Regardless of how China is perceived, the stakes are clear. The future of global trade will hinge not on short-term destructive tools like tariffs, but on each country's ability to raise value added, invest in innovations, and cultivate talents.